Good morning, everyone, and welcome to the Daily Trader with Kevin Hincks. I have two paper money trades for you today on two high-profile names. We're going to look at Apple, that is down after their earnings report. Then we're going to look at Meta Platforms, that is rallying after its earnings report in the last week. So let's get to our first trade of the day, and that is Apple. Now, if you look at Apple, it has sold off after its earnings event came out on some softness in some of the services data and things like that. So Apple is something that we're going to look at in terms of the short put vertical, a more passive bullish play in Apple, and I'll show you what that means. We're going to go out till the May 23rd. So that is 16 days till expiration, looking at the expected move of about $12.40 in that right column on the Thinkorswim platform. And what we're going to do is we're going to look at the 190 put, so something a little more aggressive, but about 76% probability that that put will finish out of the money. That's what it says right now on the Thinkorswim platform. So a high probability short put vertical. In the May 16th, in the May 23rd, got to go out one more. Sorry, I was on the wrong date. And the 190 put is a 72% chance. Sorry, I had the wrong series up. So selling the 190 put, buying the 180 put. So a $10 short put vertical. And like I said, that short put is just a bit inside that expected move out to the May 23rd. The credit on that is, we put it in at 160. It's trading about $1.50 right now. And that is the max, whatever credit you take in is the max profit on this trade, on this high probability trade. The risk is the difference between the strikes, in this case $10, minus whatever credit you take in. If it's 160, it's $840. If it's 150, then it's $850 of risk. Remember, that's always going to be the scenario on a short put vertical out of the money. The risk reward is going to be skewed to the risk side, but the probabilities are higher on a trade like this. It flips to the other way if you have a long vertical, right? The probabilities would go down, but the returns would be better. Okay, so again, an Apple short put vertical going out to the May 23rd, selling the 190 put, buying the 180 put for somewhere between 150 and a 160 credit. Whatever you take in is the max profit, and the risk is the difference between the strikes and the credit taken in. All right, now let's go to Meta Platforms. Meta Platforms, that's a stock that has rallied since earnings, and we're going to look at a continuation there in the long call diagonal. We're going to go out to the May 23rd, same expiration, but we're going to buy the 590 call, which is, about $5 in the money. Then we're going to look at the rest of this week's expected move of about $15, and that means we're going to sell the 610 call. So the 590 610 call diagonal. Now that's trading, we put it in $15.75, trading about $18.50 now. Meta has rallied off the early open. Now, why is that? Well, that is rallied because that 590 call that was closer to at the money earlier in the day is now $5 in the money. Now, it is a 2-week spread, so it's a $20 wide. You will have the opportunity, if the market's open and liquidity allows you, to extend duration on this trade. But right now, it's trading about $18.50. Again, that's the risk on this trade. The target for this trade is the $610 strike. That's what you're looking for in a move. And again, the risk is always the debit paid. So in a short put vertical, the risk is the difference between the strikes minus the credit. The risk on the long call diagonal is the debit paid. All right, that's our show for today, everyone. We'll see you tomorrow with another edition of the Daily Trader live from the SIBO. I'm Kevin Hincks.